Welcome to part one of our two-part cost segregation study mini lesson. Really excited about the content here as we start talking about tax strategies specifically for real estate investors in our Teaching Tax Flow Real Estate Investor course. Part one of the cost segregation study is going to focus on the more technical aspects of what this strategy is, where part two is going to be the application and more strategic part of this strategy. So let's jump into our part one agenda. What a cost segregation study is we talk all the time about tax agencies are our involuntary business partner. And what a cost segregation study is it allows us to reset the depreciation schedule of a piece of property so that you can take additional deductions in the front end of placing that asset into service. So we're going to talk about the asset class chart review. So we're going to look at how the IRS tells us we have to depreciate or deduct the cost of different assets based on their asset type. Then we're going to really define what a cost segregation study is more formally. We're going to look at the new rule, the Tax Cuts and Jobs Act of 2017, and then we're going to look at a sample cost segregation study report. All right. So what you're looking at now is a federal tax depreciation class table. Now, the tax code tells us, based on what type of asset you buy, how long you have to depreciate that asset. Depreciation is kind of an odd term because it implies that when you buy the asset, it goes down in value. Well, we know not all assets go down in value. So think about depreciation as just another term for cost recovery. And based on, like I said, this chart here, this chart identifies how long you have to recover that cost. Now, remember another law of teaching tax flow. Cash flow and tax flow are not the same thing. So when it comes to the depreciation deduction, if you finance the asset or if you pay cash, that has no relevance on how quickly you can deduct the asset. And that's a big misconception. Just because you pay cash for a 27.5-year asset, let's say it's residential property, that doesn't mean you get to deduct it any sooner than if you finance the entire project. So many of the 3-year assets up here would be software, tractors over the road. Many automobiles are here in the 5-year asset class as we work down up 7 years. So really with that cost segregation study, what we're doing, and we're going to look at that formal definition in a moment, we're trying to identify any of the piece of the asset. I want to take your attention here. Residential properties, 27.5-year. Non-residential properties, a 39-year. So these are long periods of time to deduct property. If we can identify 5, 7, 15-year property within that larger property, so if we can identify property in these asset classes here within the 27 and 39-year asset class, then we could deduct the property quicker. All right? So let's look at the formal definition of a cost segregation study. Now, according to the American Society of Cost Segregation Professionals, and yes, this is a very real and reputable organization, cost segregation is the process of identifying property components that are considered personal property or land improvements under the federal tax code. So we talk about that term, tangible personal property. The primary goal of this type of study is to identify all construction-related costs that can be depreciated over a shorter lifespan. Remember, I mentioned, I'm going to go back, 5, 7, 15-year asset classes. You might want to pause this to really dive into what those are here. But what 5, 7, and 15-year asset classes are living within the non-residential and residential real property asset class? Because we could deduct those quicker, which ties in well with the Tax Cuts and Jobs Act. So Tax Cuts and Jobs Act of 2017 changed how we look at cost segregation studies, and they made the cost segregation study much more attractive to real estate investors. We're going to talk about the application in part two. But let's talk about the TCJA, our acronym for Tax Cuts and Jobs Act. This can be found on this right here on this link, right to the IRS website. So if you want to pause this and go to the link, feel free. There are several question and answers that the IRS puts out for us as guidance. But let's look at the couple things that are most important. What are the eligibility requirements for additional first-year depreciation deduction? You can see the property has to meet 4 requirements, and those are right in here. Now, the new law allows bonus depreciation on question 5 here to be extended to used property. So it doesn't have to be original used property, which does include vehicles, but also includes real estate. And under the Tax Cuts and Jobs Act, we can now take bonus depreciation on real property. So that's very attractive to us. So that bonus depreciation deduction really is a driver as to why cost segregation studies make even more sense under Tax Cuts and Jobs Act. Before Tax Cuts and Jobs Act, cost segregation studies made sense, but only on really, really large properties. Well, you could see these new rules right here. And again, link to them is right there. Now, let's look at a sample report. 123 Main Street. We know that this is let's look at the assumptions here. This is a residential property. Cost basis of $400,000. I want to point one more thing out that I failed to mention in that first slide. Land is not depreciable. So we're only looking at the building portion of a real estate investment. So the building basis is $400,000. And if we do not do a cost segregation study, you would depreciate this $400,000 over a 27.5-year period, straight line depreciation. With this cost segregation study, we were able to identify, I want you to turn your attention to down here where my cursor is, 5 and 15-year asset class types within Main Street. And because this was done in 2022, and we have bonus depreciation of 100% available in 2022, this taxpayer would receive an immediate deduction on this property with a $400,000 of building basis, remember, not including land, of first-year deduction of $108,000 instead of the normal 27.5-year straight line depreciation. So this is a sample cost segregation study report. All right, this concludes part 1, and I look forward to seeing you in part 2.
John here from Teaching Tax Flow. I wanted to thank you for watching this video. We literally have hundreds of hours of content between podcasts, webinars, videos just like this built specifically for you, the taxpayer. Whether you're a full-time employee, you're a freelancer, you're a contractor in some other sense, or you're thinking about getting into business for yourself, everything here at Teaching Tax Flow is perfect for you, basically going off of the roadmap provided by the IRS to legally and ethically reduce the taxes paid over your lifetime. So be sure to subscribe to this channel and connect with Teaching Tax Flow, and we will see everybody very soon.